All right. So this is our fourth lecture on chapter 4. We've got a few more topics that we want to cover. One is, what do we do when we have when we pay somebody a bonus? How do we withhold on that? We're also going to talk about it's called grossing up a payment, which essentially means you know how much you want the employee to walk away with. You have to figure out then what it is you need to pay them in order to get to that point. So, for example, I'm given a bonus to Rohan of $1,000. I want him to actually get $1,000 in his bank account. That's what I want to give him. Well, we all know by now that if I give him $1,000 and he's an employee, he's going to get less than $1,000 because of all of the withholding that occurs, the Social Security, Medicare tax, income tax, all of that stuff. So there is a formula that can be used for figuring out, okay, so I want him to have $1,000. How much do I actually have to pay him in order to get that? So we're going to talk about that formula, and then we're going to go through and look at some information returns that have to be filed by some of them by the payroll department, many of them by the accounting department. We'll put special emphasis on those that are filed that relate directly to payroll. By information returns, I mean these are you're probably all familiar with them and have received them in the past. But you probably didn't refer to them as an information return. So these are things like W-2s. W-2s will summarize how much an employee made from one particular employer during the year. These are returns that are then used by individuals to file their own tax returns. Okay, so we're going to go through what those returns are. I'm going to kind of reverse things a little bit because I want to, we're supposed to end with, well, per the slides, we would end with talking about that pre-2020 withholding. I'm going to move that up a little bit though. We're going to talk about that next because I want to make sure that I can get to that today. And then the last thing we're going to talk about in this chapter is state withholding. And we'll, of course, pay attention to, we'll look at Iowa. We're not going to look at any other states and what other states do with regard to withholding, but we will look at what Iowa does. So any questions? Everybody's here today. Yay. Any questions before we get started? I'm sure you guys will have some questions with regard to homework. So on chapter 4, so maybe the next couple of days couple of classes, we can kind of take a little bit of time and look at those two while we're also starting to talk about chapter 5. Okay? Because your chapter 4 homework isn't due until next Tuesday. So you've got some time to do that. Okay. So supplemental wage withholding, what we're talking about here are amounts that are, usually we're talking about bonuses. So there are a couple of ways that employers can pay bonuses. They can just include a bonus as part of the overall payment, the regular wages, or they could pay it separately. And employers have a couple of different ways then to calculate the withholding, the federal income tax withholding on those amounts. The first way is to just include it with the regular wages and calculate the withholding using the methods we've already gone through, right? So let's just say, for example, we had wages of $1,000, and then we got a bonus as well of $1,000. So total of $2,000, and we're going to calculate our withholding based upon that $2,000 using the methods that we talked about last week. So nothing really special, it's just adding more income, right, to those taxable wages. So that's one way to do it. The other way to do it is to pay the bonus separately. Just pay that $1,000. And if we do it that way, we have a special tax rate that we use in order to calculate that. It's a supplemental tax rate, and it's 22% for amounts up to $1 million. Now, I hope at some point in your lives you all receive $1 million bonus. I hope I receive $1 million. I doubt that that's ever going to happen. But I mean, for me, that's DMAC wouldn't pay $1 million bonus. So 22%, and this is just a flat rate. And like I said, it's up to 1 million. Once you get to $1 million bonus, that rate goes up to 37%. Okay, so that's, but they're just the two rates. So super easy, right? You just have a flat amount that's going to be for federal income tax that we're going to apply. Okay? Yeah, Lisa.
So does $1 million count at 22%, or is $1 million the beginning of the 37%?
Let's see. Over and above the $1 million. So $1 million plus, or yeah, over $1 million plus is 37%. Okay. So if we use this supplemental tax rate, we can then gross up paychecks. It's hard to gross up a paycheck manually. Now, obviously, software can do it, but it's hard to do it manually if we're doing this, right? Not impossible, just, you know, takes a few more steps. If you're really into spreadsheets, again, you could probably figure out a spreadsheet that would do that if you're using this first method. The second method, though, is easy to gross up, and that's what we're going to go through next year. I think you do have some homework problems on this. So, okay. Like I said, it's just a formula, and you just plug in the amounts. I'll give it to you here. So, X1 minus tax rates. Whoops. This is the sum of the tax rates. All of the tax rates. Okay, so X is the amount that you want the check to be. Okay, this is the amount that you want. So for example, I want Rohan to have $1,000, or that he walks away with. So X is 1,000. So 1,000. 1 minus, and what we're going to do is sum up all of our tax rates. So we've got Social Security tax, right, 6.2%. And actually, if you're doing just 6 point, we want them in decimals here. So 0.062 plus 0.0145 plus, now we're going to use that supplemental tax rate, right, plus 0.22. We're going to assume we don't have any state taxes in this, okay? So we add all of those together. Where's my calculator here? So 0.062 plus 0.0145 plus 0.22. 0.2965 is my sum here. So 1 minus 0.2965. 70.35. So, whoops, 0.7035. All right, so we're going to take 1,000 divided by 0.7035. 1421.46. This is the amount, the gross taxable pay that we need to pay him in order for him to walk away with $1,000. So we can test that. Obviously, we'll take the 1421.46. I'll use this space here. So let's use this 1421.46. So we've got Social Security tax, we've got Medicare tax, and we've got federal income tax that we have to calculate. Start with that. So 1421.46. 46 times 0.062, 8813. Medicare tax, $20.61, and federal income tax at our 22% rate. $312.72. Do the math here. Hopefully it turns out right. 1421.46 minus 8818 minus 2061 minus 312.72. $1,000. So there's the paycheck that he gets. Now, sometimes, as you saw when I was doing the math on that, there might be some rounding issues here. What you want to do, if this turned out to be $999.99, which is entirely possible because of rounding those tax rates, you would adjust this top number here so that it works, to make it work. Okay? That's what you'll do in your problems as well, in your homework problems, is adjust that. Oh, sorry, I should have gone over here. What did you say? I'm sorry. You're going to adjust this number here. So let's do another one. Let's assume that we've got some state taxes as well, and it's a flat percentage. Again, you have to use a flat percentage, which, as you'll see with Iowa right now, we don't have a flat percentage rate. We have a graduated rate, just like with the federal. And the more you earn, the more you pay in taxes. Same thing with Iowa, at least for the time being. So you can't really do that right now, but we'll make some different assumptions. So we'll say, so here's our formula. So let's say we want, let's get this rid of this too. Let's say we want $1,250 bonus. That's what we want our employee to walk away with. So $1,250 again, that's our numerator. And let's say our state tax rate is 5%. Okay, just a flat 5% tax rate. So 1 minus, and we're going to sum up all of those tax rates again. So 0.062 plus 0.0145 plus 0.22 plus 0.05. Now we're going to add that 5% in there. Okay, let's do the math on these tax rates. So 34.65. So 1 minus 0.3465. 6535. 0.6535. So we'll take the 1250 divided by 0.6535. $1912.78. All right, 1912. Actually, let me put this over here. So our gross is 1912.78. And we got that by dividing the 1250 by the 0.6535. Okay. All right, and then we'll do the math. So Social Security, Medicare, federal, and state. All right. So 1912.78. 118.59 for Social Security. $27.74 4, we're gonna round that up. I'm hoping we get to a number that's not exactly 1250, so I can show you what I mean. 1978 times 0.22, 420.81. And then 95.64. All right. And we do our math. So came exactly at 1250. All right. Let's just say for the sake of argument, this was 82. This would mean that we would end up with 1250.01. We want exactly 1250, right? So in order to reduce that by 1 cent, we would change this to 77. Okay. Don't worry about the calculations there, but that would then change this to exactly 1250. Yeah.
What if that change brought it down to underestimate? So it's like 1249.99.
Just don't recalculate. Just use the 77. Don't recalculate these. Just go ahead and use those. Make sense? All right. So that means some. You probably all know that. But so x over 1 minus the sum of all the tax rates we're using. Questions? Yeah.
No, it's not
Oh.
a question. So that's I want to know. 06535 is if you add Social Security, Medicare, and federal income tax is supposed to be. You can take 1912.78 minus 1250. You want to get all 3 of them for deduction.
Well, yeah. You can. I'm sorry. Say that again.
Yeah. Because you take 1250 and then you use that for 0.6535 and then you get 1912.78.
Mm-hmm.
So if you take 1912.78 multiply for 0.6535, you get
Yes, you'll get the 1250. Yeah. But when we're doing the payroll, we need to have that broken down. We need to have this broken it down into the different tax rates. Yeah. Yeah.
So for Iowa, we will use the tables and maybe.
So for Iowa, we're not really going to go through grossing up for Iowa. This is because we don't have a flat tax rate.
But
for
like
Iowa.
in 10 years will be that.
Yes. So by, what is it, 2027, I think, we're just going to have a flat tax rate of 3.9%, I think it is. They're actually looking at doing away with it entirely, income taxes in Iowa. But they haven't done that yet. So, but this one, yes. So if it were 2027, we'd be able to use that 3.9% here and do this for Iowa by hand. Until then, we're going to have to use probably a software program in order to do that. Any questions out there? No? Okay. Right on. So, excellent. Okay, so let's talk about some of these information returns. The big one is the W-2. W-2 is the form that is provided to each employee at the end of the year so that they can prepare their own taxes. I'm sure a lot of you have probably received a W-2 at some point in your lives. And we're going to take a look at what that looks like. But so employers will have to prepare a W-2 for each employee that they have. And then what they do is they summarize all of the information on all of the W-2s and put it on what's called a W-3 form. The W-3 form doesn't go to an employee. to any employees because that's showing all of the employee information. It goes to the IRS and to Social Security, and it accompanies a copy of the W-2s because the employer is not only going to give a copy of the W-2 to each of the employees, they're also going to give copies of their W-2s to the IRS. So when you do your taxes, the IRS already knows what's on your W-2. So it doesn't do much good to put something, and people have tried, believe me, put something down that doesn't correspond correctly, because eventually it'll catch up with you. And sometimes that's just an honest error, right? But so that the copy goes to employees, each employee. The employer will keep a copy as well. Employees will, oftentimes actually, they usually get like 3 copies. So the employee will get a copy to keep for their own records, a copy that in the olden days when we filed paper returns would be attached to the federal return, and a copy that back in the olden days when we would file paper returns would be attached to the state return as well. You used to have hand staple them, and there are still people that will file paper returns. Sometimes you have no choice. If you've been the victim of identity theft, you can't e-file your return, or if you've got some sort of conflict with who the dependents are on your return, sometimes there are different reasons that you may have to file a paper return. So employers will always still give employees those 3 copies. And then the employer keeps a copy of them, and the employer sends a copy to the IRS as well. Now in Iowa, the state doesn't actually get a copy of the W-2s, but Iowa talks to the IRS. They have communications there. So, and then like I said, that W-3 is a form that summarizes all the information that's on all of the W-2s that employer has submitted, okay? It gets sent, so the employee has to receive, well, I shouldn't say has to receive. The employer has to submit the W-2 form to the employee by the end of January. January 31st is the deadline for submitting it. That means it can be in the mail on January 31st. So the employee might not receive it by January 31st, but as long as it is postmarked by January 31st. Now, most employers these days don't mail them out. They have especially larger employers have a online system, usually part of their payroll system, where employees can just download them when they're ready. Also, employers can just hand them out if it's a small employer and they don't have that type of system, they can just hand them out. They can send them by email, best to encrypt them if they're going to do that, or some other means. So it doesn't have to be a physical paper copy of the W-2. But this is what it looks like. Let me see if I can make it any bigger. I don't know if I can. Zoom in. That's a little better. All right. So the W-2s, employer's name, all the employer's identifying information, EIN is up there. They've got to put that on everything. Employee's information down here, name, address, employee's social security number. Now, these W-2s, if you've received one, it might not look like this. Sometimes they're in different formats. There's no standard for it. Believe me, I wish there was just a standard format. As a former tax preparer, it would be really nice if when you're looking at these forms, they all looked the same. So you know exactly where to look for everything. They don't. But they have to contain all of these boxes, right? And usually they're roughly in this type of format. So employee social security number might be up there, might be down here with the employee. Oftentimes now those are masked and they'll only show the last 4 digits of the social security number. For the protection of the employee, it will always show the entire employer identification number though. That's not protected like social security numbers are. These boxes here, box 1, 3, 5, 7, all pertain to income. different income that is taxed. The corresponding tax is over to the right. So box 1 is income that is subject to federal income tax withholding. Box 3 is income that is subject to Social Security tax withholding. Box 5, income subject to Medicare tax withholding. Now you'll see in our example here, yeah, they've got all 3 of these are the same, right? It's so all of the income that they received is subject to federal income taxes, Social Security taxes, and Medicare taxes. The same amount of income is subject to those taxes. Now remember, if we have wages over $147,000, this box here is never going to be higher than whatever that wage base is, that 147, because we stop after that point. Income is no longer subject to Social Security tax. So if you could have box 1, box 3, and box 5 could all be different numbers. If you have somebody who's made over $200,000, so they would be subject to, let's see, well, the additional Medicare tax would be listed in here as well. Let me think here. Retirement funds. Remember I said retirement contributions are pre-tax for federal income tax purposes, but they are not pre-tax for Social Security and Medicare tax purposes. Okay, so if you can imagine, let's say we've got an individual who had wages, let's say $300,000. Okay, and they had 401k contributions that they made of $30,000. All right. So, so the $30,000 has not been, we'll withhold the $30,000 is included in this. By that I mean we're gonna reduce the wages by that $30,000. If this were the case, so we would have, here's our boxes. 1. Okay, so box 1, wages, we would combine those. 270 would be subject to federal income taxes, right? Because it's not, this reduces taxable wages for federal income tax purposes. This does not reduce wages for Social Security and Medicare tax purposes. So for Social Security, box 3, we're limited to that 147, right? No more than $147,000 is going to be subject to Social Security taxes. For box 5, however, the entire $300,000 would be subject to Medicare taxes. So just an example of how those boxes, and well, this is tips, we'll assume there's nothing there, how those boxes could all be different, those income boxes. It corresponds with the amount that is being taxed, that is subject to tax. So it might not be all of their income, right? If they had paid $30,000 in health insurance premiums, well, that's pre-tax for federal income tax purposes and Social Security tax and Medicare tax purposes. So what you're seeing in these boxes isn't necessarily the total income. It's the taxable income under each of those categories. Does that make sense? And then over here, of course, is the amount that was actually withheld. Okay. All of these amounts, like I said, these amounts then go on the income tax form. So when we're doing our federal income tax return, this is the amount that's going to go on that return as our income, because that's the amount that was subject to federal income taxes. Our withholding, the amount of prepayments that we've made, we've got listed there. That's going to be, we get credited with that amount. Once we've figured out our taxes, what we owe, we get credited with the amounts we've already paid in. Right? If we paid in too much, we'll get a refund. If we didn't pay in enough, we'll have to pay more. Okay. Other boxes here. So we've got a box for Social Security tips as well. So these are tips that are subject to Social Security taxes. If those tips were allocated tips, they'd go here in box 8. Dependent care benefits. So if you had one of those pre-tax benefits for dependent care benefits and you had amounts withheld, the amount that you had held would be listed there. Most that could be is $5,000. Okay, that's going to be the max, but it would have reduced all of these taxes, the dependent care benefits. Box, I'm not going to talk about box 11. Box 12, these are for particular types of deductions. There's always a code next to it. Now this code C, I thought that was a retirement, which would be included in the, we should have a difference, I think, between these boxes of $78, but I think they did that. I think they did that wrong. But each of the, if you look on the back of a W-2, there's a whole list of codes. Each of those codes then would be, if they are relevant, would be listed here, and then the amount that was withheld would be listed in that next to it. Okay, so things like health insurance, that's code DD. HSA contributions, that's code W. I don't know all of them off the top of my head. Different types of retirement plans as well have their own codes. So those amounts would be there. If the employee was a statutory employee, this box would be checked. If they participated in a retirement plan, this would be checked. That is relevant because if somebody participates in a retirement plan and they want to contribute to an IRA, an individual retirement plan, they may or may not be able to do that because they're already participating in a retirement plan through their employer. Third-party sick pay, this is for like disability pay, that sort of thing. AFLAC, that stuff. This is just sort of additional information that doesn't have a box. This information, when you're, for the tax preparer, this could be relevant information that is needed, but it just doesn't have a box for, you know, where it goes. It means that it's probably going to go elsewhere, somewhere else on the tax return. It's like this. This has Pennsylvania SUI. This is state unemployment insurance. In this case, the employee must have paid $17.62 toward that unemployment insurance. In the next chapter, we're going to talk about unemployment taxes. Most states, employees don't have to contribute anything to that, but there are some states where they do. And then they've got this Blue Cross Blue Shield health insurance premium, $296. That actually should be in a code over here, but they put it there. Everything down below pertains to state information. Okay, so this is the amount of, and you see this one actually is different. 18, so this must be different by the $78. So in this case, they've got state wages that have subtracted this $78 from that. So that their state wages are less, state taxable wages are less than their federal taxable wages. Now, ordinarily that, in this case, because I do think that's a retirement plan, it should be for the federal as well as the state. So, but at any rate, then they've got the amount of state income tax that was withheld, local wages and tips. So if they live in a place where there are local income taxes, and these are all just income taxes, okay? That's the only kind of tax that this pertains to, not property taxes, not sales taxes, not any of those other types of taxes that are out there. There are some localities that have local income taxes. So, and usually they're, well, not exclusively out east, but they tend to be in those states where it's more expensive to live as well. So this is obviously Pennsylvania, and Philadelphia has an income tax. So in Philadelphia, they had $1,127 withheld from local income taxes. That means they're going to have to file a local income tax return as well. You can see this one actually, local income tax was actually more than the state income taxes. But so that's what, so each employee gets one of those. And then the W-3 summarizes all of the information on all of the W-2s. Okay. Questions about the W-2? Yeah.
So like if you live in a HSA, like the home area that you have to pay like monthly, does that?
That's not a tax.
Oh.
Yep, that's not a tax, that's a fee. And so that wouldn't show up anywhere here. That would, and it wouldn't even, it's not even deductible. It won't have anything, any tax implications. It's just a fee that the homeowners association charges. And that's separate from property taxes. Property taxes you would then pay to the county. Other questions? Okay. Let's see, how do I get the, oh, there we go. Right on. Okay. So there are, like I said, those W-2s have to be issued to employees by January 31st, and then they have to be sent in to the IRS. I think the IRS deadline is also the 31st of January. For a while there, they were playing around with some of the deadlines, and it was like the 28th of February, but I think it's the 31st. So January is a really busy month for payroll departments, right? Because they're not only doing all of the quarterly returns. Remember, those 941s are going to be due as well. They've also got these annual returns that are going to be due. And when we get to chapter 5, we're going to talk about that unemployment tax return, which is also due in January, by the end of January. So super busy month for the payroll department. And just as the payroll department is finishing up, then the income tax department gets really busy after that for the next few months. So remember, we've got those 941s that have to be filed on a quarterly basis by the employers. There are also some other types of information returns that have to be filed. Most of them have annual filing requirements. Some of them, though, are actually, I think only the 941 has a quarterly filing requirement. But remember that 941 is a form that we have to file every quarter. It's going to include information about how much in wages we paid, taxable wages that we paid over the course of the quarter. It's going to include how much we withheld in federal income taxes, Social Security taxes, and Medicare taxes. All that information is going to be there. All 4 of those 941 forms for each of the quarters for the year, all of that federally taxable income, the wages have to equal the sum total of those federal wages on all of the W-2s. So everything has to match. Also, the amount that's been withheld by that's listed on the 941s, all 4 quarters, when you total them up, have to equal the total amount that was held on all of those W-2s as well. Same with Social Security tax, same with Medicare tax. Okay, so it's a way to reconcile as well. At the end of the year, you use those W-2s and the W-3, where everything's summarized, to match to the 4 quarters of the 941. Okay. All right, so we already talked about the 941 a lot. 943 is the same as a 941, except it's for agricultural employees. So you do see those in Iowa, because we have a lot of agricultural employees. 944 is the form, it's the same information as on the 941, but if you owed less than $1,000, you can file it once a year, right? And so that's the form that we would file once a year if we had just a very small amount that was withheld. Let's see, 945, you'll see these all start with 9. 945 is the form that is filed pertaining to federal income taxes withheld on other types of income, interest, dividends, let's see, other types of so backup withholding, which we're not going to take the income tax class. We talk a little bit more about backup withholding, but amounts of withholding from pensions, annuities, gambling money. So this is kind of a catch-all for different types of withholding. Now, not all of those types of withholding always have, or not all of those types of income always have withholding associated with them. And many of them are not required to have withholding. But if there is withholding, the form that's filed to report that withholding is Form 945. Okay. Now we're going to talk about some 1099 forms. 1099, again, so just like that Series 900 pertains to different types of income, the 1099s pertain to different types of income as well. But you'll see they're all called 1099, but then they have a suffix at the end that gives a little bit more description of what type of income. These report income to individuals who have earned that income. So if you have received dividends during the year, you're going to get what's called a 1099 DIV, which reports all of those the amount of dividends. Now, in the payroll department, you are generally not going to be dealing with most of these because the accounting department would be issuing most of these types of returns. But this is just to kind of give you a little rundown of what they are. 1099G, government payments. If you got a state income tax refund, it would be reported to you on a 1099G. Also, I think unemployment as well is reported. Agricultural subsidy payments, again, that's something you do see in Iowa. Those are reported on a 1099G, G standing for government, right? 1099 INT, this is interest income. So you can see the name does give a bit of a description. It gives you a clue as to what type of income they're reporting. 1099 MISC, that's kind of a catch-all. If it doesn't fit on one of the other 1099s, it would go on a 1099 MISC, standing for miscellaneous types of income. It used to be that independent contractor income was reported on a 1099 miscellaneous form. That is not the case anymore. It has its own separate form, which is good because if you recall, that self-employment contractor income is going to be subject to Social Security and Medicare tax because it's self-employment income. All these other types of income aren't subject to Social Security and Medicare tax. So they were putting income that's subject to Social Security, Medicare tax, FICA, combining it with income that wasn't subject to FICA. That can be very confusing. So what they did was they gave it its own form. So anything on a 1099 miscellaneous income form, rent income, royalty income, that kind of thing isn't going to be subject to self-employment tax. But if it shows up now, this is the new form, 1099 NEC, non-employee compensation. That is going to be subject to Social Security and Medicare tax. So now it's got its own form. This is one form that the payroll department may have to send out. This one may be a responsibility, just depending upon the company, because they're payments that went to contractors. And if the payroll department is the one that is the department that made those payments, now oftentimes it's the accounting department that does that, but it could at times be the payroll department, right? Even though they're not employees, they're contractors, they're receiving pay for services, okay? But that's the 1099 NEC. 1099 PATR, again, you see this in Iowa a lot. This is for if you received income in the form of dividends from co-ops. When people belong to co-ops, especially farmers belong to co-ops, they'll get dividends as well. Sometimes it's in the form of discounts, but it's taxable income when they receive those. Don't worry too much about that one. I'm just kind of just as an FYI. 1099R is for retirement income. R stands for retirement. Could also be in different types of insurance contracts. 5498, this one is actually not a form that reports income. It shows how much was contributed during the year to an IRA, individual retirement account. So that form is usually just kind of an FYI if you need to remind you of how much you contributed, if you did. And then the employers do have, if you've got employees that are tipped, there's an annual form 8027 that has to report tip income and any allocated tips as well. So there's all these forms for different types of income that have to be filed every year. Okay. Questions about those different forms? That's a very quick rundown. You are welcome to go out and look at them. Take a look them up. They're all online. You can find different examples of them. Let's see. Oh, this one's talks. So I don't know if you have any questions about this. I'll mention the 1096. So remember, the W-2s, all of the W-2s, all the information on the W-2s gets summarized on a form W-3, right? All gets totaled up, summarized on W-3. 1099s are the same. They have what's called a summary form. They call it a transmittal form that summarizes all the information that's on the 1099s. It's called the 1096. Okay, so just as an FYI, if you have any homework questions, I can't remember. I thought there might be, but I don't recall specifically. But that's what the 1096 is they're talking about here. All right, I'm going to skip over the state right now. We're going to start talking about this. The pre-2020 methods of withholding. So remember, we had the wage bracket method and the percentage method. And we have it for 20 and earlier, and for 2020 and later. Remember, this is pertaining to the W-4 form, with which W-4 form we're using. So we have both of these methods for the new method, the 2020 and later, and we have this method for the 2020 and earlier method. Okay, so we're going to be going through both of those methods. If the W-4 form is, whoops, I should have said 2019, sorry. 2019 and earlier. Again, that year pertains to the W-4 form that's being used. Doesn't mean that right now it's 2019. You can have somebody who's getting paid in 2023, but their W-4 was from 2019, so we've got to use this old method because of that. They should really update their form. And employers can encourage that, certainly. Okay, so, and remember I said we had 4 different pieces of information that we needed in order to complete. So anybody remember what those 4 were? And I said 2 of them are exactly the same, whether it's 2019 and earlier or 2020 and later. So the first one, taxable wages, right, taxable wages. We need that for the old and the new. What else?
Frequency of payment.
How about frequency of payment, right? We need that for both. I'm just going to put frequency up here. What are the other 2?
Filing status, married or single.
Filing status. For the new method. And then what was the 4th one? Checkbox, right? Yes, no. All right. For the old method, we don't have filing status or checkbox. We have instead
Married, single, and allowances.
Right. Married, single, and allowances, number of allowances. All right. So just like with the wage bracket percentage method for the more current forms, wage bracket method is easier. We're using a table. Percentage method is more complex because it's going to pertain to a higher level of income because we can't use the table. Right? All right. So now I had sort of given you a little bit of a preview on what I meant by these allowances. I think I told you that, you know, the tax returns used to have what were called exemptions, and these allowances related to the exemptions that we had on our tax forms. We don't have exemptions anymore, and so that's why they took away these allowances. But the allowances, you would get one allowance for each person on your tax return. So if you were a married couple with 2 kids, you could take 4 allowances. You could get allowances for other things as well. If you were going to be itemizing your deductions, if you were going to be claiming a child tax credit, if you were going to be claiming dependent care expenses, all sorts of things could add to the number of allowances that you took. The higher the allowances that you claimed, the lower the withholding. So there's an inverse relationship between that. That information would be listed, the number of allowances would be listed on the W-4 form. It's up to the employee to determine how many allowances they have. Now this W-4 form, which I'll show you, the old one here. I'll make this bigger again. A little big. This is the old W-4 form. So you can see, and I mean, you remember the other one was a full sheet, right? This one is just a partial sheet. It was about a third of the page. Now, there were supplemental instructions on the back of it and other sheets as well. And there might be additional worksheets for the employee to fill out to help them answer some of these questions. But it was simpler. As far as the payroll department goes, it was simpler to deal with because it was much smaller. Again, name, address, thinking that that's a touchscreen. Social security number up here. Single, married. Now you'll see there's a third box. It says married, but withhold at higher single rate. There were 2 rates that could be applied to the withholding. If you checked single, that meant that more was going to be withheld, as though you were single, right? So you could be married, but tell the payroll department, no, I want you to withhold like I'm single, okay? The opposite could not be true. You couldn't be single and check married. It was only, you have the opportunity to have more withheld. You don't have the opportunity to have less withheld. So single, married, or married but withhold at the single rate. So essentially this means single. So that's where this married single comes in, okay? Number of allowances that you are claiming from the applicable worksheet on the following pages. So like I said, there were other worksheets that you could fill out. But in this case, so this individual chose 4. You'll see how we use this number in just a minute. Okay, but this does figure into our calculation. Next line, which we have on the new form as well, additional amount that you want withheld from each paycheck. So if you decide that's not enough to have withheld, you want to, or you've got other income that you know you're going to have to pay tax on, you don't have withholding on it, you could have an additional amount. Just choose a dollar amount. Once the payroll department has calculated what the withholding is, then they add much more to the withholding. Okay. They had this other line, if you were exempt. Now, usually this really just pertains to like high school students or college students who are dependents on their parents' return. They have a little bit of income, but they really don't, because it's a small amount of income, they usually don't have to pay taxes. If you did not owe any money, any taxes last year, and you expect that you're not gonna owe any this year, you could just write exempt in here, which means no withholding is gonna take place. There's not gonna be any federal income tax withholding. What that does is it saves the person from having to file a tax return. Maybe pay somebody to file a tax return or go buy TurboTax or just going through the hassle of filing it if they end up having no filing requirement. Okay, so they would just write exempt there. And then there was a space for the signature. And that's it. Oops, here we go. That was kind of it, other than those supplementary worksheets that would have been attached. All right. So we need, let me pull up, where is it here? I thought I had this already open. Apparently not. Okay, so we still need this publication 15T. Same one. We're going to use it for the same, whatever year it is, that's the one we're going to use. So 2022, we're going to use the 2022 one. Remember, this pertains to the W-4, what's on the W-4, the year that's there. This pertains to the year we're working with, which for us, this is what we're working with. All right, so we're going to need that still. So you can see, remember we had these different chapters pertain to different types of methods. Now we've got wage bracket method, 2020 or later. Wage bracket method, 2019 or earlier. Okay, so what's this one we're going to use? 2020 or later for percentage method, 2019 or earlier for percentage method. We're going to use that. So we're using different chapters now. All right, so let's take a look here for 2019 and earlier. So you see we've got a table, right? All of our information that we've gathered, we can apply to the table. So on the left-hand side, so first thing, we've got our frequency right up at the top again. So here's weekly. But we also have, this is a little bit different because the other tables had all of the filing statuses listed on the same table. Now we have a separate table based upon married or single. So weekly payroll period, married. Okay, so there's our frequency, and then there's our married or single. So you've got to look for those two items up at the top of the table to get the right table. So now, not like I said, not only is it the frequency to determine the right table, it's also whether you're single or married. Okay, so same concept though as the other tables. We've got our wage range, our taxable wage range over here on the left-hand side. But instead of that filing status up at the top, now we've got the number of allowances, whatever that number was on the W-4. So for this gentleman, I think it was 4 was his allowances. I don't know what his income is, but we would be looking at this column to see how much is withheld. So let's play around a little bit. Let's say we've got, let's say we've got some, well, you guys can give me this. Again, make it a lower number so that we know they'll fit on the table. So taxable wages, give me a number.
777.
777, there we go again. How often are they paid?
Weekly.
Weekly. Married or single?
Married.
Married. Number of allowances?
5.
5. All right. So now we can use that information to look it up on the table. So we need to find the weekly married, well, right here, how convenient. 777, next thing we're gonna do is look up where 777 falls, between 770 and 785, and we've got 5 allowances. This starts with 0. So you can see here, the higher, the more allowances you have, the lower that withholding is. So 0, 1, 2, 3, 4, 5, $11.
How you did that?
Starts with 0 up at the top.
Okay.
First column is 0. Yep. So if you had 0, which is, you can claim 0 allowances. Even if you're entitled to more allowances, you can claim 0 allowances. Now you'll see the tables, these tables, not only do they end as far as income goes, once we get to a certain income level, it's going to go off the chart. Also, we can only go up to 10 allowances. Individuals can have more than 10 allowances. So if the income doesn't fit on the table, or if the number of allowances doesn't fit on the table, then we have to use this percentage method. Okay. So, do you want to do another one? Or you guys think you have this? Yeah.
We can do the percentage one. For example, let's say that weekly was $1,500.
1,500.
Uh-huh.
Okay. And what else?
The allowance is 11.
11. Okay. Well, this is a good one. We'll use this for percentage. Was it married or single?
Married.
Married. Okay, we'll use that one when we go through the single. Yeah, go ahead, Ben.
So like, if you're in that 320 to like 330 range,
Mm-hmm.
and it's like 0 starting from 1, and you have 11 allowances,
Mm-hmm.
could you just like,
It's going to be 0.
okay.
Yeah, you can use your logic. Yep. Say, oh, yep, that's going to be 0.
So allowances, does it mean like your number of in your family or just the kids, or how do we calculate?
Well, the allowances you don't calculate the allowances. The employee lists that on the W-4. It's the employee's responsibility to list the number of allowances. And they can use the worksheets that accompany the W-4 to determine how many allowances. Yes, usually they pertain to each person that's going to be their tax return, but it pertains to other types of tax information as well to calculate the number of allowances. But those allowances are going to show up, not there, where is it? Right here on line 5. So whatever is entered on line 5, your problems are going to tell you. They're not going to ask you to figure out how many allowances. They're going to tell you how many allowances. Because that's something, like I said, the payroll department doesn't determine that. The employee determines that. That's the employee's responsibility. Does that answer your question?
Yeah, I mean, like, cause like the number of allowances, they can just put whatever they want, right? Or
Well, no, not necessarily. Because if you notice, I mean, yes, they can, however, there could be repercussions for that. It says here, under penalties of perjury, I declare that I've examined the certificate to the best of my knowledge and belief it is true, correct, and I think it says complete. And complete. So they are attesting to the fact that they are entitled to these allowances. If they make up allowances, then they've just perjured themselves. And it can come back to them. Now, how often does that happen? Probably not very often, but I mean, the IRS will, if you've got a company and you're paying 100 people and somehow none of them have any withholding, the IRS is going to get a little suspicious, right? Or if they see an employee, somebody who's constantly not having amounts withheld, because they know that W-2, if they had $80,000 worth of income and no withholding during the year, the IRS is going to get that W-2 and they're going to know. And then they might start asking questions, right? So, but it is ultimately the responsibility of the employee, because they're the ones that are signing this, right?
One question on that.
Yeah.
Do you have like a list of allowances that you can look?
There's a worksheet.
Okay.
So there are worksheets, let me see if I can find, because they don't really include this here. Let's see. W4 19. Let me see if I can find the whole thing. Okay, so here is the entire W4. Here, let me see if I can make this bigger. Nope, that's not what I want. Exit. There. So here's that first page there, but then all of the instructions and worksheets. So if you don't know how many personal allowances to claim, and again, you don't have to deal with this W4 anymore, because you're not going to give this W4 to anybody. You're going to give them the new one, but it could be that they still have this old one on file. So nobody's going to have to make that decision anymore, how many allowances. But so just an FYI, the worksheets would help to guide them with that. So like one for yourself, one if you're going to file married filing jointly, one if you're going to file as head of household, one if you're single married filing separately, one job, spouse doesn't work, yada, yada, yada. Child tax credit. Okay, are you going to get the child tax credit? If your total income is more than the limits, enter 0. Okay, but you may get a 2 for each eligible child. So the more, again, that just means you're going to be entitled to more deductions, more credits when you file your own tax return, and that will increase the allowances that you are entitled to. You don't have to take them. The employee does not have to take them, but then that reduces the amount that's being withheld. So it reduces their prepayment, because the assumption is they're going to owe less in tax, right? We kind of start with this assumption. If it's 0, the maximum amount of tax the employee is going to be subject to the maximum amount of tax. We keep adding numbers here, it reduces that assumption to lower and lower amounts of tax. But again, you're never going to give somebody this W4. We're done using it initially, like to give to people to fill out. They would never fill out. If they want to fill out a new one, they fill out the new form, right? But there are still these that are in use, people who haven't filled out new forms. Okay, let's see here. I'm lost.
Oh, we were gonna do the percentage method?
Yes, I'm looking for my, oh. Okay. We already did that. Okay. All right, let me pull up the form again. Where is it? Sorry, I don't know if I exited. Oh, there we go. Okay, so that's pretty easy, right? You just apply it. The hardest part is making sure that you've got the right table, right? But if you cannot use that, then we go to the wage bracket method. I'm sorry, the percentage method. So, percentage method. All right. So you can use this worksheet if you want. I'm not going to use it right now. I'm just going to kind of show you how to do it, but you can follow along with this worksheet. So I'm going to take these out, and this. We've got our 4 pieces of information. And again, just like with the newer method, you can always use this. You can always use the percentage method, even if it's from the table. You know, you could get the information from the table. you can use this percentage method. It's going to be more accurate. It's going to be down to the penny, just like it was when we did the newer method, right? All righty. So you guys can see that's kind of hard for you guys at home. I don't know if you want to pull this up yourselves, if it's easier to see. I know sometimes it's kind of hard to see. All right. So what we're going to do is we're going to take our taxable wages. We're going to start with our taxable wages. So we've got 1,500. Right. We have to, based upon how frequently we're paid, we're going to multiply our number of allowances by the appropriate number up here. So if we are being paid weekly, the amount here is 83. This is where you can, and we're going to subtract this amount then from our taxable wages. So you can see how the higher this number is, the more we're going to subtract, right? All right, so we're going to take our allowances times, and I never quite know what to call these numbers. Frequency table, I don't know. Amount on frequency. That's just my wording, I don't know. Okay, so 11 times 83. And we're going to subtract that. Get the 913. All right, so 1,500 minus 913, 587. Is our adjusted amount. Then we're going to take that 587. We're going to apply it to the appropriate table down here. These look familiar, right? Same concept. Same, again, we're going to find the range, and then we're going to use we're going to follow our directions that are here. We need to find the right one though. So we got a weekly payroll period. We got a married individual. All right. So at least 250, but less than 645. We've got 587. Let me double check something. I think I did that in the right spot. I just don't do these very often anymore. I want to make sure. Oh, shoot. Yeah, that's right. Okay. I just want to make sure I did something in the right order. Okay. Now I forgot what it was. Okay. All right. So again, we've got to find the right table. So here, this is our weekly payroll period. Now, this one is a little bit, here it's a little bit simpler because we've got, remember before we had an entire sheet based upon different filing statuses. We had different tables, checkbox yes, checkbox no, that sort of thing. Here, it's a little bit more condensed. We've got the weekly payroll period. This is bi-weekly down here. So it's either going to be this one or this one that we're using. They're married, so we want to make sure we're using that. Between 250 and 645, the amount is 587. Tentative amount to withhold is 0 plus 10% of the amount over 250. So 587 minus 250 times 10% equals 3370. let's look at the other table and see. I think this one, oh, because it's 11. Yeah, it wouldn't show up because it's 11 allowances. I was going to compare it to this, but. Sorry, guys, making you guys dizzy. Oh, shoot, I gotta go back up to the top. There we go. All right, so the amount to withhold would be then $33.70. Again, you can use these instructions line by line to get you to where I was. Let's do another one. You guys can give me some information, and we'll do this. Okay. Taxable wages. Give me a number.
4,500.
How much?
4,500.
4,500? Okay, 4,500. How often?
Bi-weekly.
Bi-weekly? Married or single?
Single.
Single. Number of allowances?
8.
All right. So, okay, we're going to start with the 4,500. And then we're going to subtract number of allowances times, so it's biweekly, 165. Okay, so 8 times 165 is what we're going to subtract. 1,320. Okay. 481. So 3,180 is now the amount. So now we go to the table. Bi-weekly, so we're going to use one of these two, and they're single. All right, so 3,180 is between 1,774 and 3,593. So the tentative amount to withhold, 184.92. Let's write that down.
22%.
22% of the amount over 1,774, right? All right, 706. 1,406 times 22%. $309.32. We're going to add these two together. 184.92. 494.24.
The 184.92 came
Came from behind the calculator. Right here.
okay.
Yep. That. So whatever number is here, just like set it over to the side, do the additional calculation, then add that to that additional calculation. Make sense? So it's very similar, but the biggest difference, of course, is this number of allowances. Remembering to multiply that by whatever the appropriate amount is on this table. This is in your book as well. They've got this listed in your book. Okay. Questions? We'll save going through the Iowa for Thursday. We'll start with that. You don't really have any, you don't have any homework problems with it, but I want to just briefly show it to you, and how it works. If you've got any homework questions as well, I'm happy to go through those. I don't want to take the whole period because I want to do want to get started on chapter 5. But any other questions that you've got on this stuff, I'm happy to take a look at with you. Okay. All right. Oh, it's a little bit early, actually. 4 minutes early. That never happens, does it? Usually I'm keeping you here past. You've earned it. You've earned those 4 minutes.
Okay.
You owe us from that.
Yeah, I probably owe you about 40 minutes, but.
Do you know, I mean, is there a specific formula or order for that we can write down and just follow it?
I can,
Next
let
Tuesday.
me see.
Like a guided formula or?
I can see if I can put something together. This kind of, taxable wages, subtract this. All of for the table. Let me see if I've got something. I might have.
I kind of wrote some stuff out, like
Mhm.
from the table, like the amounts like from the table. That way I kind of remember
Right.
where I got the amounts from.
Right. Let me,
Just to know if there's any. If not, it's okay. We can probably go through that. But
yeah, let me see if I can put something together. And let's see, I might have something from a previous year. I'll take a look. Okay, and if not, I can.
if not, it's okay.
I know. I like the steps as well. Like I said, you're welcome.
I have like a quick question, but it might be like outside the box. You
Okay.
might know. I just come up with these stupid questions all the time. I have a friend who lives in a different country,
Mhm.
right? He called me, he has some sort of online business
Mhm.
that he does.
Mhm.
And what happens is $100 a year is a lot in my country.
Mhm.
So what he wants to do is, he wants to send me money here.
Mhm.
Like, let's say he wants to send like $25,000 a month.
Mhm.
How do I show that to IRS? Because I want to do it legally.
Well, is it, he's just giving you money or whatever, or there's a
It's
business part
Some
to
sort of
it?
business that I have to send it back to my country. And then
Okay,
it'll be more.
gotcha. So it
But
will,
I will
okay,
take
so,
my percentage and then only send him some, like, let's say if he
Right.
sends me $1,000.
so he's like an investor, really. He's like investing